So I think this is not something that will stay for us forever. It's cyclical, but it requires that you are adjusting your offering and your cost structures as an asset manager. International investors are watching closely how much the policy improvements have an impact before they reallocate. Clients who are invested, they typically stay on because they know they're invested in okay companies. At the moment, you can buy quality at the discount. It's not around one single stimulus package or one initiative. And to my perspective, the China government does an excellent job of just gradually, step by step, addressing these problems structurally.
Hi René, thanks for joining us today. As we know, global asset management industry has been undergoing some radical shakeups in recent years. According to a PwC survey, 1 in 5 asset managers will vanish in 5 years' time. So what's your own observations of this industry consolidation?
I think it's certainly a trend where certainly in the last 2 years you have seen some significant lower valuations. So what it requires is for you as an asset management to really zoom in on your core capabilities that you think you make a difference to your clients, where clients are willing to pay a certain premium. So we have narrowed down and focused on the areas where we think we have specialist expertise and have merged or closed funds that are not happening. So I think you will see that trend to continue, but I think it also forces you then to optimize your cost in the back. Historically, asset management business assets go up and down with markets, right? So that's just reality. So you need to be quite flexible and adapting your costs as much as you can.
So we've seen large net outflows from asset managers as investors choose to park their money in money market funds. So do you see this trend continue in 2024?
It's an interesting one. In 2024, I think investors can get income yield again, right? So fixed income is back, as I like to say. Because you basically can invest in global investment grade bonds, for example, and you get a very attractive risk return yield above money market funds. So I think this is not something that will stay for us forever. It's cyclical, but it requires that you are adjusting your offering and your cost structures as an asset manager.
Yeah, as we mentioned, some of the challenges the industry is facing, such as like digital transformation, shifting customer expectations, retailization, and so on. So what are the biggest concerns?
So I would not necessarily call it concerns. I think it's an opportunity. Take AI as an example, right? We're exploring actively how can we use AI in the data consolidation that we use to do research for companies that we're investing, right? So if the data that you collect are wrong, then your output is wrong and your recommendations will be wrong. So I think the industry is actively adapting to these opportunities. So I don't see it less as a threat, but it's the opportunity to provide cheaper solutions over time and faster solutions over time.
So actively embracing this.
Absolutely, yeah, I think that's critical. I think companies that will not adapt or sit on the old business models will have a very challenging time going forward.
Yeah, let's move on to China. So there are some pessimistic narrative around China's recovery story. According to official data, the economy has grown 5.2% last year. So what's your take on the latest monetary easing policy announced yesterday?
What does it take that international flows, for example, come back to China? And I think the reality, it's confidence, right? So if I look at us as an active equity investor in China, we own some great companies, great business models, high double-digit earnings growth potential, but valuations are very cheap because investors are not confident enough yet to reallocate, right? So I think you get At the moment, you can buy quality at the discount. It's not around one single stimulus package or one initiative. And to my perspective, the China government does an excellent job of just gradually, step by step, addressing these problems structurally. So as we work through the real estate policies, hopefully the policies that will come in place will help to smoothen this out. I don't think there is one fix and everything goes away. So the economic transition of the policies will take time. I personally feel in this environment, buy companies and stocks that have good balance sheet, good business models, that have healthy earnings, and you will be fine.
What are the bright spots, as you mentioned, these great companies? Do you have any specific industries or sectors?
So we have always focused on very much on sectors that are somewhat policy aligned. Aging demographics, so healthcare is a very big topic. Consumer who spends more on lifestyle, selective stuff. You certainly have the whole sustainability or green angle. I think you know the industries such as electric vehicles, solar, all these energy transition topics that are very, very long-term and I think very structurally powerful. So there are plenty of investment opportunities that are aligned with what the policymakers are making. Yes, it will be volatile at times, but I think if you are a long-term investor and diversify your portfolio, I think there is opportunities.
So you mentioned valuations. As we know, China market is relatively cheap compared to other very popular markets in the region. How do global investors look at the China market? Are they very still cautious or starting to thinking about investing in China again? So what kind of suggestions you would offer to your clients?
So our clients are still very cautious. This is a very big year for geopolitics and elections. There will be a lot of noise coming out of it. So I think that's one thing where clients are nervous. Is it the time yet to allocate? We see clients diversify a bit more across Asia. So they're realizing that Asia is not just China, right? There are great opportunities across the region. So they diversify a little bit more across India, Japan, Korea, and Taiwan. I think international investors are watching closely how much the policy improvements have an impact before they reallocate. Clients who are invested, they typically stay on because they know they're invested in okay companies, but adding new money, long-term money will take a little bit time. You might have the short-term traders who they think, oh, the policy stimulus comes out, bounce, let's go in. That's not what we are advocating. We think China is a long-term investment theme. It's the second largest economy in the world. There are plenty of opportunities for investors if you stick for a long-term investment horizon.
So do you think it's a good buying time or timing to enter the market at this valuation or at this?
So I will go back to my quote. You buy quality at the discount right now. If you're a long-term investor, I think it's as good as any time to invest in China.
So you say that on-the-ground due diligence is very critical for fund managers to gain a holistic view of the market. And you also visited China last year for the first time after the pandemic. So how did you feel on the ground? What kind of momentum or sentiment did you feel on the market?
I came back after my first trip and shared with all my colleagues in the office very positive sentiment. And I was convinced that actually the consumption rebound will be faster. I certainly was wrong. But I still believe that actually there is gradual improvement of life in China every day. I am super conscious of structural challenges that you have in the country, but most major economies go through these cycles, right? And I think that's what we need to restore over time. But I think China in the long run will be fine, but they need to work through these cycles.
So let's talk about your China market strategy a little bit, because as we know, Aberdeen has signed a MOU with China Construction Bank last year, the nation's second largest bank. So can you share a bit more on the partnership with China Construction Bank and what's your overall strategy towards China market at the moment?
So I think in general, there are probably three angles how we look at China. One is international investors who want to invest in China. So that's when we do research on the ground and help it. The second one is when China institutions want to invest abroad, so that we give them access to global expertise. And the third element is around how can we participate on the China domestic growth. And I'm of the strong view that as an international player, you need a strong distribution partner or a local partner, where a joint venture with Hang On. So so that's an insurance joint venture where we are looking particularly to develop the pension business across China. So our strategy in China domestic is really find suitable partners who want to build over time the expertise that we can help them to build.
Hong Kong is the largest asset management hub in Asia. So, and the city has a Wealth Management Connect scheme with other cities in the Greater Bay Area. So how do you see the opportunity that can present to foreign asset managers like Aberdeen in the years to come?
So, first of all, I'm a big fan of the Greater Bay Area idea and concept. I think the progress has been a bit slow in a context of what asset managers can do to participate. And that's a function a bit of still somewhat limited instruments and tools that we can provide for investors. But I think as this evolves, Hong Kong has a very, very important role to play. So you will always hear me that Hong Kong will remain a very, very critical location for international asset managers to work and collaborate with China. The Greater Bay Area, the different Connect schemes, the Wealth Connect schemes, as they evolve and hopefully provide more access to international content, that will make a difference, right? Today, the tools that I can provide for Chinese investors are very limited. And as a result, as an international asset manager, I provide very little added value to Chinese investors, right? Today, where I can provide global portfolio diversification or more access to international products, I think that's where it becomes very valuable for international asset managers to work around the Greater Bay Area. So for me, it's more a question, not if, but when it will happen, and that's what we're watching very close.
I think the authorities or regulators have taken a step-by-step approach towards that, because it's like a new model, a new Connect scheme.
I think I've seen these Connect concepts come to life. I agree with you, they need to be properly tested and thought through. I appreciate that takes time.
Aberdeen has a great focus on like sustainable investment or ESG and the so-called specialist investment, the expertise you have, the core competitiveness compared with other peers or counterparts. So can you share a bit more on that?
Yeah, so I want to zoom particularly in on the sustainability bit. We see more and more institutional investors in particular. So for example, if you distribute Asian investment content to European institutional investors like pension funds and the likes, they have very clear criteria of what sustainability looks for them, right? So as we invest in China or Asia in general, when we pick companies, we really work with them very closely to also help them to understand what disclosures international investors would like to see. So one big story that is very important is in Europe, there is a lot of exclusion happening. So do not invest in brown companies, right? That's not possible in Asia because many economies here are still in transition. So we are looking from how do we build portfolios that help the transition to go from brown to green, right? And so what we do when we apply ESG, we really discuss with the companies, what are your transition plans? How do you measure it? And if they have credible plans, we are willing to invest in them because it's the money who helps them to transition.